Hey everybody, thank you for tuning in. Today is Wednesday, January the 10th, and I'm going to go over a trade I put on a few minutes ago that expires this Friday. It's a 2 DTE rather than a 0 DTE. Kind of close, but let me show you what's going on. A brief recap of the early trade this morning. It's actually been pretty quiet. I want to show you a chart here so you can take a quick peek. This is a 1 minute. So we opened a bit higher from yesterday's close, and then it started to rally a bit, but I was looking to actually get short term a little short here, and then thinking that maybe, let me see if we can, maybe we would shoot up by Friday up to 4,200. So notice that this area here, we're talking about 4,770. This is this morning, about 15 minutes after the open. These are 1 minute candlesticks that I have going here. And anyway, so what I did was, let me show the fills, and we'll just focus on, well, actually, that's all I did here so far. All right, so as the market was trading at about 47.68-ish in the SPOOs this morning, I decided to sell. The first thing I did was I sold a call spread. So this is a bearish call spread here. And the strikes that I used were 48.05 and 48.10, expiring this Friday. So let's go out to what I have for this Friday. So here we go. I sold the 05 and bought the 10, and I did that at $1.20. And then I was looking for the market to have a bit of a pullback. And what I wanted to do at that point, I was very lucky. I did get a bit of a pullback, just enough basically to put on the other side of the trade, which is what I wanted to do. So let me continue with that. All right, so I had a bearish call vertical at 05.10 in the 48 handle. Sold it. Obviously, it's a bearish call spread. Looking for the market to pull back. However, note that this is a 2 DTE, and I don't want to necessarily say obvious reasons, I'm looking for a rally between now and Friday, and possibly pinning around this 4,800 number. The significance of this number itself should be maybe I shouldn't say obvious, but it looks like an obvious place if there's bullish sentiment going on, which clearly there is, for this to pin. Now, it doesn't mean it's not going to close on Friday at any other point, 47.50, or maybe it'll pin down here. Who knows? But I just decided that this would be a good play. So rather than get out of this for a small profit, which I probably could have done, I wasn't looking to do that. I was looking to do a couple of other things possibly. So I could have butterflied into this and sold an 05 and bought an even, and that would have given me a butterfly. So it would have looked like that. So I hedge off the directional risk to the upside, and at 120 or less, at 120, if I would have done this trade, I would have had a butterfly on for free. However, I'm not necessarily crazy about doing butterflies because it's basically like picking a slot on the roulette wheel and hoping that it hits, pins, in this case at 05. However, I could have done the trade for free or possibly a small credit. Instead, what I did, or something else I was looking to do, is I could have sold this put spread sold the even, bought the 95, and at the time I was pricing this out, it was getting close to $4. So imagine if I sold this put spread, the even 95 for $4. So I'd have a $4 credit there. I'd have a $1.20 credit here. And that would have created a synthetic condor. And think about what happens with the 520 collected. All right. So let's say that the market rallies and it blows through all these strikes. Am I at risk? What can I possibly lose? What's my max loss on this trade? Which I'll give you a hint. If I would have done it at $4, it would have been, my max loss would have been a min win. So I would have been covered there. So go through the numbers and think about how that eliminates all my exposure and what the credit is. I'm not going to do it because I think this is something to definitely put pencil to paper so that you understand it well. Now, that's one way to hedge off the risk, lock in a small profit, and leave myself the potential upside. The other way is what I actually did. I bought the 95 even spread here in the calls. So I didn't want to screw around with it too much because at the time I did this, the SPOOs had gone under 47.60 and it was close to my break even price, and I didn't want to miss it looking to put on the trade for a small credit. So I originally had this trade buying the call vertical priced in at about $1. I said, I'll let it go. I'll take a little more risk. Maybe I can get this on for a credit, this whole package on for a credit. I ended up not waiting. I went up to 110. I went up to 115. And then I decided that the market was looking a little skittish, possibly refueling at this point for a little bit of a rally. So I paid $1.25. And what that leaves me with is this position. Let me go to the analysis tab. I think it'll be a little easier to see that way. So what I have is sold, this is the 12th. So I bought the 95 even and I sold the 0510. All right, and I did this for a debit of 5 cents. I was looking to get a small credit, but now let's look at what we have here. So I have a condor. My min win, or my max loss rather, is going to be this $5 you see here on P&L exposure part that's highlighted in red, the $5. So worst case scenario here, I lose $5. And remember, this is a one lot on each side for each spread. Best case scenario is I get the trade to close out between even and 05, and I would end up making $4.95, which would be 500 on the width of the spreads here, and minus the $5 that I ended up paying for the trade. So let me go back to the table. All right, so let's say that this rallies, and let's say we're somewhere around 4,800 on Friday. Obviously, this call spread here is going to, let's say it goes out at full value. So the max value here would be the difference between the widths, which is $5, times 100 is 500. This bearish spread would go out worthless. That's fine. So I get the $500 minus the $5 that it cost me to do this trade. I have on a condor. Now, I didn't get out of this. I could have kept playing for the initial bearish call spread I had on, just hoped, maybe the market will just tank from here. It'll go down another, whatever, 10, 20, 30 handles. Let's see the expected move. Let's just say by Friday, by the way, is somewhere around 47.20. And I could have just closed it out for a small profit. But what I actually wanted to do was what I mentioned, because I'm looking at this, what I mentioned earlier, because what I'm looking at is this 4,800 number, and it just looks like a spot that the market wants to probably go to on Friday. It's hard to say. Nobody knows for sure, but I decided to place a bet on it. We'll see what happens. And what I ended up with eventually was I eventually ended up with a Condor here for $5, and I get a look at 500 with no risk should the market blow through these strikes to the upside or not go anywhere near these strikes for the remainder of the next 2 days. All right, I hope that was helpful and interesting. If you liked the video, send a link to a friend so they can check it out and think about how to wiggle in and out of trades and what price you're looking for, and also how to, remember I mentioned using puts here, using a put vertical. So this would have been a synthetic condor. Okay, thanks for watching. I'll catch you guys next time.